Hello everyone, are you ready to take your accounting skills to the next level? Today we are going to start very important topic of accounting guiding rules. We are also going to cover accounting concepts, the very foundation of financial accounting. Stick around till the end because mastering accounting is like finding the final piece of a puzzle. I'm sure you don't want to miss how it all fits together. Let's start. In Chapter 1, Introduction to Accounting, we learned the objectives of financial accounting and its 7-step process. Now, in order to follow the accounting process, we need some rules and guidelines which are universally acceptable. We all know by now that accounting is a business language. As rules for grammar exists for every language, similarly accounting rules and guidelines exists for financial accounting. GAAPs or generally accepted accounting principles are the basic rules that defines the framework within which the accounting operates. In other words, GAAPs are the guidelines for preparing the financial statements, that is profit and loss account, balance sheet and cash flow for any business. GAAP, that is the basic accounting guideline rules, can be classified into 3 buckets: accounting concepts, accounting principles, and accounting conventions. These accounting principles, concepts, and conventions are the guidelines basis which the financial statements are prepared. These guidelines are universally followed for recording business transactions and preparing financial statements. These rules are followed in giving accounting treatment to various items of assets, liabilities, equity, expenses, and revenue of the business. We will discuss accounting concepts, principles, and conventions in detail in our next slides. Let us now understand the word GAAP. It is a generally accepted accounting principles. As the name indicates, it is a set of universally accepted accounting standards, principles, and procedures to be used to compile the financial statements. Let us now learn few basic key rules for accounting. Rule number 1 is how the business recognizes its revenue and expenses. That is, what are the conditions which must be satisfied for recognizing the revenue and expenses for a business. Rule number 2 is what type of expenses are capitalized as business assets. Rule number 3 is rules regarding the presentation of financial information to stakeholders. Number 4, what relevant facts and information needs to be disclosed in the notes to the accounts for the financial statements. Let us now understand the reasons why GAAP is required. GAAP provides uniform framework for accounting practices which makes financial statements comparable across businesses and time periods. By adopting GAAP, businesses are expected to produce reliable and error-free financial statements. Disclosures required by the GAAP ensures complete and absolute transparency and gives confidence to the stakeholders that the financial statements are true and fair. It also brings the accountability on the part of the companies who are preparing and sharing the financial statements with the stakeholders. Let us now learn few important facts about GAAP. There is no one common GAAP across the globe. Therefore, GAAP adopted may vary from country to country. For instance, in US, the GAAP is defined by their Financial Accounting Board, FASB. All the US companies follow US GAAP. Many countries in the world follow International Financial Reporting Standards, which is popularly known as IFRS. IFRS is defined by the International Accounting Standard Board, IASB. IASB is aiming through IFRS to standardize accounting practices globally so that there is more transparency and improved comparability of financial statements across the globe. European Union countries, Canada, Australia, and several other Asian countries have adopted IFRS, but still many countries use their own local GAAPs. In India, Indian Institute of Chartered Accountants have issued the Indian Accounting Standards to standardize the accounting practices in India. So a business which operates in US will follow the US GAAP, while a business which operates in India will follow the Indian accounting standard for preparing their financial statements. Accounting concepts are also known as accounting assumptions. Accounting concepts are the underlying assumptions that form the foundation of accounting. Accounting concepts ensures that the financial statements are consistent, comparable, and reliable. In case a business does not follow or change any accounting assumption, that business needs to disclose it in their financial statements and the reasons thereof. There are three accounting concepts: going concern concept, consistency concept, and accrual concept. We will discuss each of these concepts in detail in our next slides. Let us first learn the concept of going concern. As the term going concern indicates, it is assumed that once a business is established, it will operate indefinitely. In other words, it is assumed that a business will continue to do business for foreseeable future. The word foreseeable is often used to explain the concept of going concern. It actually means indefinitely or for a very long period, but it does not mean forever. Therefore, business is established with no intention to close down in immediate future. Because of going concern concept, distinction is made between revenue and capital expenditure. On the basis of going concern concept, fixed assets are always recorded at their original purchase cost and are depreciated over their useful life. Fixed assets are expected to benefit the business for a longer period. This is the reason that the total cost of the fixed asset is not charged in the accounting year in which it is purchased. Now, in the example given on your screens, the business has invested INR 10 million in fixed assets because it is assumed that the business will operate for a longer period. Financial statements are always prepared basis going concern concept. This concept ensures that the business transactions should be recorded and reported on the basis that the business shall continue for a very long period. And there is no intention to close or scale down their business operations significantly. Second important concept or assumption which we will learn now is the consistency concept. As the literal meaning of the word consistency indicates, once an accounting practice and principles are applied, it is assumed that the same shall continue to be followed year after year. As a result of consistent adoption of accounting methods, comparison of financial statements over different periods become meaningful and thus helps the shareholders in taking rational decisions. Let us understand the concept of consistency with an example. There are two methods of charging depreciation on fixed assets: written down value method and the straight line method. Under consistency concept, a method of depreciation once adopted and applied shall be applied year after year. For example, if the cost of a fixed asset, say, is INR 1 million and the depreciation under written down value method is charged, say, at 20% per year, the depreciation amount under written down value method will look like the way it is displayed on your screens. In the starting, the amount of depreciation is high and then it is gradually reducing. Quickly, let us learn how the depreciation under written down value method is calculated. In year 1, 20% shall be applied on the original cost of the fixed asset to get 200,000 depreciation for year 1. Now for year 2, year 1 depreciation of 200,000 will get reduced from the original cost of the fixed asset, and the depreciation for year 2 at 20% will be charged on the reduced value of fixed asset, that is 800,000. Same logic will be applied for calculating the depreciation for year 3 and beyond. Now under straight line method, same amount of depreciation will be charged, say INR 125,000 per year. In our example, business has estimated 8 years as the useful life of the fixed asset. As per straight line method, the depreciation for year 1 to 5 is displayed on your screens. Now, depending upon the method of depreciation adopted, the depreciation will be charged year after year. I'm sure we understand now why consistency in accounting is essential. It impacts the business performance and business financial position. We will learn in detail about fixed assets, depreciation, and their impact on the financial statements in our subsequent chapters. This question is often asked, can we change a method of accounting once it is adopted? The general rule is once an accounting method is adopted and accordingly accounting practices and principles once applied shall consistently be applied year after year. However, if the change in the accounting method are necessary due to change in law or accounting standard requires such a change, or the change will result into a better and meaningful presentation of the business information, it can be changed. However, such a change should be fully disclosed together with the reasons for change in the financial statements of the business. Next accounting concept which we will learn is accrual concept. According to this concept, a business transaction, whether it is a revenue or a expense business transaction, it is recorded in the books of accounts at the time when it is entered into and not when it is settled. This concept helps in matching revenue recognized with the expenses incurred to generate such a revenue. This concept ensures more accurate financial performance of the business. Let us understand this with an example. If the accounting period is say January 24 to December 24 for a business, and the business scenario which we are going to analyze now is XYZ LLC company sold goods worth INR 250,000 to another company ABC LLC on 9th of September 2024, and both the companies agreed to settle the payment after 90 days. ABC LLC took the delivery of the goods on the same day and acknowledged the receipt of the goods. This business transaction will get recorded in the books of accounts of both the companies on 9th of September 2024. Now, if we analyze this transaction for XYZ LLC, INR 250,000 is a sales transaction, and for ABC LLC, it is a purchase transaction. Both will record this transaction on 9th of September 24 even if the transaction is not settled on 9th of September. This is an example of accrual concept for both revenue and expense. Now let us understand why it is important to record this transaction in both companies' books of accounts on 9th of September. For XYZ LLC company, the impact of this transaction is the sales will increase, stock will reduce, and the receivables will increase because the goods are sold on credit. While the impact on the books of accounts of ABC LLC will be purchase or stock will increase, payables will also increase because the goods are purchased on credit. Let us now take another example of assets purchase. XYZ LLC purchased 5 laptops for their office staff on 30th of September for INR 250,000. They took the delivery on 30th of September and promised to pay the supplier after 60 days. Now, since the laptops, which are the assets of the business, are acquired on 30th of September, and the business must record this transaction on 30th of September. By entering into this transaction, assets of the business will increase and the payables will also increase as the laptops are purchased on credit. Let us now try and answer few questions related to the topics which we have just discussed. Question number 1. Give 2 reasons why accounting concepts and guidelines are necessary. The answer is it makes financial statements comparable, and second, financial statements are not influenced by personal bias. Question number 2. Which principle requires personal transactions of the owners should be debited to their drawings account? Yes, the principle is business entity principle. Question number 3. ABC company purchased and paid for a computer for proprietor's son for his college studies. Proprietor instructed his accountant to debit it to fixed assets. Is proprietor correct? The answer is no, proprietor is not correct. According to business entity concept, since it is for personal use, it should be debited to drawings account. Question number 4. Which concept assumes that the business is established to operate indefinitely? Going concern concept. Question number 5. A new business adopted written down value method for charging depreciation on fixed assets for year 1 and 2. In third year, they decided to shift to straight line method of charging depreciation. Please comment on this. The answer is no, they cannot change. According to consistency concept, once a method of accounting is adopted, the same should be applied consistently year after year. Question number 6. Revenue should be recognized when the payment is received. True or false? Answer is it is absolutely false. Revenue is recognized when it is earned and not when it is received. Question number 7. An expense is incurred on 7th of July 2024. However, the payment is made on 7th of September 2024. In which month business should book the expense and which concept is applicable? The business should book the expense in the month of July as per accrual principle. Question number 8 on your screen is, what do you understand by the term accounting concept? Accounting concepts are the underlying assumptions that form the foundation of accounting. They ensure that financial statements are consistent, comparable, and reliable. Question number 9. Explain going concern concept. Answer is, it is assumed that the business will continue to operate indefinitely, and it is also assumed that the entity will continue its operations for the unforeseeable future. Question number 10. Explain consistency concept. Answer is, once an accounting method is adopted and accordingly accounting practices and principles once applied shall consistently be applied year after year. Question number 11. Explain accrual concept. The answer is, revenues and expenses are recognized when they are earned or incurred and not necessarily when the cash is received or paid. In part 2 of chapter 3, accounting principles and accounting guiding rules, we will cover 9 very important accounting principles. Please note down the date and the time for our next video. If you like the content of our video and like the way we explain the topics, please like, comment and subscribe to our channel Accounting Buddy. Please do not forget to press the bell icon so that you don't miss our latest posts. Thank you and goodbye.